In this video, I would like to give you a step-by-step guide on how to develop your personal investment philosophy. You cannot achieve much without a personal philosophy that will guide your investment decision. That's what this video is all about. Developing a personal investment philosophy involves creating a set of guiding principles and strategies that reflects your financial goal, your risk tolerance, your time horizon, as well as your personal values. And so here is a step-by-step guide to help you develop your own personal investment philosophy. Number one is define your financial goal. Define your financial goal. This might be short-term goals, it might be long-term goals. When it comes to short-term goals, you identify objectives you want to achieve within the next 1 to 5 years, such as buying a home, funding your children education, or building an emergency fund. These are aspects of short-term goals. When it relates to long-term goals, you need to outline, your goals for the next 5 years and above. All right, 5 years and above, into the future, such as retirement, major life events, or wealth accumulation. These are aspects of long-term goals. Number two is assess your risk tolerance. Assess your risk tolerance. These have to you have to take into consideration your personal comfort. So evaluate how comfortable you are with the possibility of losing money or experiencing market fluctuation. As an investor, ask yourself, how will I react if I lose 10, 20, or 30% of my investments? That will determine your level of risk tolerance. All right. You equally incorporate investment horizon. Consider your investment timeline. Longer time horizon generally allows for higher risk tolerance due to the ability to recover from market downturns. If you have that particular long-term focus, that will help you to be able to absorb risk in the market compared to if you are just a short-term trader or a short-term investor. So you assess your risk tolerance, in line with your ability to absorb the inevitable, downturn and inherent risk that's commonly, available in the market. Number three is determine your investment style. You determine your investment style, which could be active or passive. It might be growth or value. In the case of active versus passive strategy, you decide whether you prefer an active management approach, frequent trading or market timing, or a passive approach like buy and hold or index investing. Okay. When it comes to growth versus value, so you have to choose between growth investing, focusing on stocks with potential for specific, price appreciation, or value investing, looking for undervalued stocks with potentials for future growth. If I may come in here, I want to share my own personal philosophy. Essentially, I prefer or I frequently adopt value investing, but it's not a decision or philosophy that is cast on concrete. No, essentially, I am a make money investor. Sometimes I adopt momentum, as the case may be. Most of the times I adopt value investing, and sometimes I equally go with growth investing. But let it be a money investing a money making strategy. That's my personal philosophy. As long as it makes money, there's no hard and fast rules, about being tied down to a certain strategy. I tend to like emphasize flexibility when it comes to my personal philosophy as an investor. Number 4 is establish asset allocation. Establish asset allocation. In this case, you incorporate diversification. Determine how to spread investment across different, asset classes like stocks, bond, real estate, commodity, hedge funds, index funds, private equity, as the case may be, to reduce your risk actually. And then you have strategic allocation, which has to do with decision on the percentage of your portfolio to allocate to each asset class based on your goal and risk tolerance. What percentage am I going to allocate to stock? What percentage to other asset classes? That's what is called, strategic asset allocation. Number 5 is develop an investment strategy. So in this case, you have a selection criteria. So you create criteria for selecting individual investments such as fundamental analysis or technical indicators or ESG, that is environmental, social, and governance factors. So you select your criteria. Equally, you have the need to select an investment vehicle. In this case, you decide on the type of investment vehicle to use, such as mutual funds, exchange traded funds as ETFs or individual stocks, or you may equally incorporate retirement accounts. Number 6 is implement risk management techniques. Implement risk management techniques. In this case, you might inculcate diversification. Ensure your portfolio is diversified across various sectors, asset classes, and geographic regions. You may equally incorporate stock loss order. You may set up, stop loss orders to limit potential losses on individual investments. I think I will take time to do a video on these different kinds of orders. Please, if you like it, you can put it in the comment section. The other one is rebalancing. Regularly review and adjust your portfolio to maintain your desired asset allocation. So you rebalance your portfolio regularly whenever the need arises. Number 7 is set up a review process. Set up a review process. This has to do with performance monitoring. Regularly track the performance of your investment and assess whether they align with your goals or not. You equally need to reevaluate your philosophy. Okay, so periodically review and adjust your investment philosophy based on changes in your financial situation, goals, or market conditions. Your philosophy should be flexible. It should not be cast on concrete. All right. Make sure that you apply flexibility depending on market condition, depending on your goals, depending on you having hit a particular financial target. You need to sit down and do work and reevaluate your investment philosophy. Number 8 is consider tax implication. It should be tax efficiency when it comes to your portfolio. And so develop strategies to maximize tax liability, such as tax loss harvesting or investing in tax advantage accounts like your Roth IRA, your 401k plans, and other similar accounts. So you have that capital gain. So understand the tax implication of buying and selling investments and plan accordingly. If you sell your investment within a short period, you will then incur, if you sell at a profit, at a gain, it will incur a higher tax gain, a higher tax rate. If you sell, after a long period of time, like over a year or so, it will attract a lower tax rate. Number 9 is incorporate behavioral factors. This will involve emotional discipline. Acknowledge how emotions can affect or impact investment decisions and strive to make rational, data-driven choices. Your, your emotion could be your greatest enemy when it comes to investing. So put your emotion in check. This is difficult, but discipline yourself to make sure that your emotion, are placed under, are placed in check. The long-term perspective. Maintain a long-term perspective and avoid reacting impulsively to short-term market fluctuation. Don't make decisions based on short-term market news or market events. No, don't be, you know, don't be influenced to sell or buy shares because of short-term market activities. Be a long-term thinker, a long-term investor. Be a fundamentalist when it comes to your decision in the market. Number 10 is align with personal values. Align with personal values. This has to do with ethical investing. If desired, integrate personal values into your investment decisions, such as focusing on sustainable or socially responsible investing. Like on a personal level, I don't invest in breweries, no matter the kind of profit they are making. Of course, they make huge profit, but I don't drink, and I don't invest in alcoholic beverage companies. You equally have philanthropic, goals. Consider incorporating charitable giving or impact investing into your overall investment strategy. You may bring in ethical investing. You may bring in that desire to see how your investment can impact the society, the environment positively. And so in summary, developing a personal investment philosophy involves defining clear, financial goals, assessing risk tolerance, and then choosing an investment style, and establishing a strategic asset allocation. And I must emphasize this: you cannot do much without a personal philosophy. Have one. You may keep it flexible, all right, but make sure that you have a guiding philosophy, a guiding principle when it comes to investments.